Hey guys, welcome back to Invested. Funny question. It's about RV, manufactured home products. How do you work with corporations when you can't really compete? I'm looking to buy an RV and MHPs. I like mom and pop type operations that need value add that just needs updated. I came across a campground that is owned by a corporation who bought the property for corporate retreat and for employees to use to take their families. No P&Ls to speak of. Property has been sold for quite a while and they keep lowering the price every couple months. Realtor called me and said they had a cash offer at $150,000 less than the asking price they turned down. I'm not this kind of cash buyer. How do you structure a deal between a corporation and a new investor that benefits both parties? Tax implication, work ethic, art of the deal, what's the secret? Thank you for asking that question. And this is a commercial real estate channel, but it's a good question because everything in life is sales. And people would disagree. What do you mean it's sales? Well, when you want to date someone, it's a sale. You're representing that you're the best person that they need to date. If you want to raise, you have to negotiate with the firm, with your supervising manager, that why you deserve a raise, not because inflation's up. Hey, what kind of work products I produce? This is a metrics. This is a KPI. I add a lot of value to the company. So with that, I believe that I add tremendous value and therefore I should get a rate. That's a sales pitch, right? When you go on a girl, hey, you got to date me because I'm the coolest guy in town. How do you do that? It's a sales pitch, right? And when you're picking business partners, same thing. So here you're asking, what's the secret? There's no really a secret sauce for it. Everyone wants to win, right? So how do you get to a win-win situation? And I think that's what you're really kind of asking about. And it seems like I like this question because I recently purchased an RV park. That's a resort type. And I picked it up from a mom and pop operator. So I thought it was interesting. And the group, if it was a corporation, it might be different. So just because it's a corporation, that doesn't mean they're good at operating the asset or they're really good at negotiation. It could be a big bureaucracy and they might just be really slow to answer. Sometimes mom and pop operator might be best to negotiate with. Or even on the other side, corporation, they just don't care. Maybe there's a small asset on their books. They'll like to get rid of it, so they'll just give you a discount, or it really doesn't move the needle for them, right? So in here, if you really feel there's a lot of value add potential and not knowing the P&Ls or whatever your investment thesis is with this asset, I would approach it holistically. I'll look at the purchase price and see if that's even a fair deal, right? And what I'm saying that is essentially, if it's completely empty, you have to do a lot of value add. It could be CapEx, it could be time, rebranding, remarketing, trying to look at the off-peak, peak season, how to get that metrics up to generate more NOI, which is your net operating income. So then you got to look at the purchase price and say, well, if it's a fair price, you don't need to discount it so much where it's going to offend them. It doesn't really matter if you offend them, but you're not going to get the deal, right? So what is the price that they will take? And I think the broker can guide you a little bit best on that. And if you're not an all-cash buyer, and these guys are not really interested with cash flow because they're using it for their employees, what you do is seller carry. So as an example, if they want $1 million, maybe you strike a deal at $900,000, right? Then you put in 20% down or even 30% down and have them carry as a lender for the next 2, 3, 4, 5 years. I think longer the better. And most of these corporations are not lenders, so they're not going to be too rigid on your collateral, your expertise. So it's going to be a lot easier to work with them because they're not an institutional lender. So they might be able to carry that and give you a favorable rate. And sometimes they'll give you interest only. So meaning that if you borrow, if it's $900,000, you put in $200,000 and you get a loan for $600,000 from them, which they're carrying, they might give it to you at 6% interest only. And interest only versus amortize over 25 years or 10 years or 30 years, like traditional house, you're not paying off the principal. So there's only interest. So there's a balloon payment at the end. But what that really helps with revenue generating assets are your initial cash flow. So you have less interest payments so that you're going to have a better NOI. So now it gives you time for the next 2-3 years to really stabilize that asset and really fulfill your investment thesis. And that's going to be really best for you. So I think in a win-win situation, the art of the deal is to go back to them and you let them know why you love this asset. Don't go to them and say, hey, you guys ran it like so bad and this is why I need a discount. No one wants to hear that. This is how I approach it. Look, I'm a new investor. I have done a couple RV parks. I think your asset is fantastic and you guys maintained it and you guys took care of it so well. And I know I could keep that asset and keep your asset and manage it really well for you guys. So I think that I'm the right buyer, but I'd like to pay $900,000 using my example, right? I know you want $1 million, but I believe it's really worth $900,000. And I can do that and sign the contract in 30-day DD and 30-day close. But would you, given the market liquidity and the interest rate market is so challenging, would you carry and do a seller carry? And here is my accolades. I have ran some other businesses. This is what my P&L looks like. Would you be able to do that? And if they really, you sell that if they really believe you're the right buyer. And I have seen a lot of cases where a lot of the landlords will do a seller carry. Assuming that they don't have financing, right? If he's owned by all cash, and then they can do that. But if they have financing, well, they have to get the proceeds to pay off the debt. So that might be challenging. But I'm assuming that they own it free and clear with no lenders and stand encumber. So that's going to be the best approach. If not, the best thing is get to the price that is amicable with both parties and get a longer due diligence and closing so you can go out to your friends and families, to other potential investors and syndicate that. But when they're syndicating, you got to have to pay them a little bit more than what it is. So by syndicating that, you can buy it all cash. Then it gives you opportunity to right size, mark to market, and create that value add. And 2-3 years down the line, you can get permanent debt financing and pay out most of the principals out to your LPs or your syndication partners. Then you can cash flow. That's how I will take a look at it. There's no guarantees, but a lot of people use a very pessimistic approach of like, oh, you guys maintained it horribly. This is bad, and want to get discounts. And trust me, no one wants to hear that they did a horrible job maintaining stuff, right? It just hurts their ego. Regardless if that's true or not, doesn't really matter. So you really want to be very cautious and be, very polite, giving them the pros and cons and why you're the best, and just win them over. And if they're a corporation, they're well-funded, who knows, they might be able to do a seller carry for you. And if not, you go with the syndication route. And that's transferable to any asset classes. We have done seller carry on an RV park. We just recently acquired. We have that seller carry on a retail. Actually, I was the one who actually provided seller carry to a couple of the investors before on retail assets in Arizona and Texas. So it can go both ways. It's the other party just wanted us to float it for about 6 months. So it was like almost a hard money loan. They paid me 18%. So, financially it made perfect sense. And if they did it, I just took over the asset back. So I was in a win-win situation for myself. So that person knew that. So that's what they were able to get a seller carry for myself. I hope that information was helpful for you. And if you have any other comments or questions, feel free to add to the box below. If you found this content helpful, please like, subscribe, and add comments. Thank you very much.